Palo Alto Networks is a stock and a company that has done incredibly well recently. We can see over the last 5 years, it's up 360%. That is very impressive. If we zoom out, it only gets better. Early 2015, a decade ago, it was somewhere in between. It was somewhere in the low 20s, 21 to 25, somewhere in that range. This is clearly a company that's outperformed the S&P 500 dramatically. For comparison, S&P 500 somewhere up around 100% over the last 5 years, 200% over the last 10 years, maybe a little bit more if you factor in dividends, but still. This is a company that has done incredibly well. It's in an incredibly important space. They have a large moat. I mean, we're just going to dive into this stock. I mean, the PE is a bit higher, but we're going to tackle all of that in today's video. We're going to look at PE, we're going to look at earnings, we're going to look at historical revenue. We're going to dive into the stock, and we're going to see, okay, is this a company that should be invested in? Maybe it's for you, maybe it's for no one. We're going to find out in this video. Of course, when investing in a company, you have to actually understand what that company does. Palo Alto, it's fairly simple. They're just a software company that specializes in cybersecurity. That's a pretty good space. Cybersecurity is just growing as an industry constantly. Also, software companies generally have higher margins. And once you establish yourself with many companies, generally companies don't like to leave. That's a huge pain. So you create a larger barrier to entry for competition the more and more you grow. So that is a positive also, specifically with their cloud cybersecurity platform. That is very interesting. Cloud is just going to continue to grow and ramp up. We see investing in AI and cloud and all that continue to accelerate with all the Mag 7 stocks and even outside of that as well. Huge industry. There's generally high profit margins, so businesses love investing more and more into it. I mean, you can just see if those companies, see the Microsofts, the Googles, the Metas, they make a lot of money off their cloud and web services. And they do some AI integration as well. I don't know too much about it, so I'm probably not going to. If you want to read up on it in this section, or of course, do research in the video, I would encourage that as well for investing. But this is a company that, like I said, generally software companies, you would expect higher margins, things like that. Decent barrier to entry. Schwab says their economic moat is already pretty wide. It's not that surprising because they are a larger company, 123 billion. But also, something interesting enough is they're also just coming out of profitability. So we can probably expect their margin to increase over time, closer to, just accelerate. I mean, we're going to look into it a little bit later. Actually, let's do that right now. This is one of the perfect examples of how PE, although incredibly helpful in most cases, it really isn't quite accurate here. And that's because they have a lot of different factors distorting the actual PE numbers. I mean, if we just look at the baseline, we can see PE is 49, forward PE is 59. Now, of course, that is relatively high. The average S&P 500 of its PE is 30, and then forward PE is 23. So clearly we are significantly higher. However, it's not entirely accurate, especially when you look at, let's go back here real quick, when you look at the PE 49 and then forward PE 59, you would expect that, okay, this company is going to have worse earnings next year, so they're shrinking a little bit. That's not true in this specific case. What we're looking at, GAAP versus non-GAAP earnings, you have to release PE with GAAP earnings, but that doesn't necessarily mean that's the full picture. So many different things can distort it. Maybe you got free money from the government through some sort of program, or you're writing off debt. You know, you merge with another company, you're writing it off. Oh, we took this loss, but you didn't actually take that loss. You actually brought in more money than last year. So it's just like a one-time thing. So now if we look at GAAP, or non-GAAP, excuse me, we can see here, okay, we had a huge increase, awesome. We had more increase, and then next year we're expecting about 12%. So you can already tell flat off that's not entirely true. I don't know exactly what they're projecting for GAAP, but it looks like that is probably the more accurate one to go off of, considering what we're reporting here is 3.64, and then non-GAAP is 3.17. That looks roughly around that 59 forward PE range. But so that is high. It is high. However, you do have to factor in another thing, which is also really distorted when you're factoring in, and we're going to dive into this later, but specifically this is a company coming from non-profitability to profitability, which that just tells you that the PE isn't entirely accurate as well, because you often have dramatic increases and decreases in specifically why am I missing it? Profit margin. Profit margins fluctuate dramatically, because think about it, if you're break even and you have, let's just say, well, they have 8 billion in revenue, right? This last year, 2024. Let's just say you have 100 billion in revenue, you're Amazon, right? 100 billion, you break even. Okay, that's not that much. Now, let's say you increase profit margin 1%. Okay, you're making $1 billion. and then you increase revenue by, let's say, 7%. So you're 107 billion, and then you're making 1 billion. Then next year you increase, same thing, so you're at 114 billion, and then you increase it by another billion, 1%. You're at 2 billion. Now you just doubled your forward PE, or you just doubled your PE, you doubled your forward PE. If you're looking to 3 next year, you can see how, okay, you're not really growing that fast. You're going at a 7% rate, but your PE can halve, because you just need slight increases in the profit margin, and it'll make a dramatic effect on PE. So it's when you're coming profitable, it's really not as accurate. So honestly, I'm more concerned about growth than just earnings per share growth, revenue growth, and everything growth. And we can see revenue increased 25%, 16.5%, and 14%. And we're going to dive into it later, but since 2019, there was a huge run up, specifically with revenue from 19 to 20 and from 20 to 21, which doesn't really show you, and even 21 to 22. So the 3 years leading up, 19, 20, 21 were very, very good years for this company, but even then, 25% and 16.5. You would expect this is very good. If you have a company that's growing near 25%, right, every year. And like I said, you can increase earnings per share even more than this. Although next year it looks like the projections are 14 and 12, so earnings per share is less. Although it wouldn't be surprising to me at all if they could increase earnings per share quicker than revenue over, let's say, a 5-year period. Would not surprise me at all. I'm not saying it's going to happen, but that would not be shocking one bit. So really what I'm seeing here is, yes, factoring the forward PE, it still is a high PE, certainly for where it is right now. But company is growing incredibly fast, right? We're basically 2.5xing revenue over a 5-year period, and also you could probably increase that earnings per share pretty fast. So a company that has been this successful, yes, even a forward PE near 60 doesn't shock me that much, and it doesn't entirely worry me. Now, of course, I wouldn't want every single company I had to be like this, but if you're getting a growth stock in this level, in this specific space, I really am not too concerned about it. Looking at the balance sheet, the first thing I always like to look at is debt, because it tells you a lot about what the company's been up to. And, that just shows you how fast you can escape debt. With this company, it was at over $3 billion. So it was at $3 billion compared to $3.4 billion in revenue a year. So you almost have as much debt in revenue you're doing within a full year. And now you're at $964 million while doing $8 billion in revenue. Isn't that crazy? You went from having more debt than basically as much debt as you had revenue for a full year, and now it's an eighth of that in just 4 full years, 5 full years. That is crazy. That is really crazy. So debt really is not a huge issue anymore. Honestly, you wouldn't be surprised to see that rise. Certainly if they keep investing in growing revenue near the rates they are, then it would become not as important anymore at all too. And see 684 million in profit in 2024. It's really hard to compare profit growth because you really can't. When you're going from a company that's not profitable at all to become profitable, that's a plus. But your earnings per share is going to fluctuate so wildly until this stabilizes a bit more. We're a few years into full profitability status. I'm really not going to compare that as like the vehicle of growth. The main thing I'm going to do is revenue, and revenue is phenomenal. 2.35. That's still significant for profit. It's just different. It's just complicated. So the revenue, like I said, 3.4 billion. It's over 8 billion. That's over 2xing, just under 2.5xing in a 5-year time period. Clearly, we do not expect this going forward. If you get anywhere near that, even if you're 2xing every 5 years, that is phenomenal growth. You're going to clearly, over the long run, outperform the S&P 500. It's not even really close. Don't expect any company to over 2x every 5 years. But the fact that they were able to do that shows, one, that they at least have good leadership, but two, they're also able to grow. There's probably more room to grow because, like I said, this is not a ginormous company. $123 billion market cap isn't small by any means, but there's still clearly room to grow. So I don't see anything super concerning here. Mostly just impressive what they've been able to do. And then as long as we see earnings per share continue to grow, as long as we see revenue continue to grow, like I said, you would need it to still perform better than the S&P 500 just because of this PE being higher. Now, if over time you started to grow closer to an actual company than the average company, 10 to 12%, then the PE went down to 30, but over time you still grew fast enough that you outperformed the S&P 500 in that time period, then it's different. But we would still need this company to grow faster than the S&P 500 because if it starts growing like a normal company, it'll probably be valued like a normal company in that well, you'll lose some appreciation on the PE wise. But other than that, I don't see why this company couldn't do that. If you guys have seen my videos before, you know I like to take a look at historical PE just to kind of see, okay, this is where the PE's at. Are we more cheap? Are we expensive compared to where we normally are? Obviously, this company has not been profitable, so we're going to look a little bit at the actual revenue, historical revenue, just to kind of get a scope of, okay, this is how much we've increased. And going back to early 2015, right? Revenue was about, what, 0.21, so 218 million a year. Or quarter, excuse me, this is quarterly, 234 million. Currently, we are sitting at over 2 billion. So nearly within a decade, 10xing revenue. That is a pretty incredible performance, and that's why you see such a dramatic increase in the share price. I mean, yes, you get an inflation in PE as well. People want to buy into it. You're paying more per revenue than you would for a normal company, but you're 10xing revenue in a 10-year period in a very important industry, tech, very important industry of tech. So it's not that surprising why you've seen these crazy increases. Not that you can't see crazy increases in companies that don't deserve it. You see that. But in this specific case, you shouldn't be that concerned with seeing crazy increases in the stock price, certainly when you're a company. Also, this small, doing only a 234 million and you're not profitable, people are also going to put a riskiness, okay, this is going to be less valued because it's more risky. Now we are a profitable company. Our debt is not large. Unless things start really going off a cliff, we aren't going to see like a dramatic, a risk of bankruptcy. It's not even close there. But when you're looking at a company that does 234 million in revenue quarterly and they aren't profitable, it's a lot more concerning. It is. So it's not that surprising why we see such an increase in share price. Like I said, not that you have to buy it. I'm not saying, you have to buy it at these prices. But this isn't like, super scary. We're just running up dramatic. It's based off of real earnings that are happening. Of course, every business has unique risks and advantages. It's important to lay them out before you actually invest so you kind of understand the advantages, risks, what you're getting yourself into. So with Palo Alto specifically, there's a couple that come to mind. The first is just with the share price of the PE being high. I think if there's a major recession, Palo Alto probably gets rocked pretty hard for a couple of reasons. One, they're a high growth tech stock with higher PE. People are going to assume that, okay, the rates are being higher, it's going to hurt their debt, which they don't need a lot of debt, but just make the assumption, right? People are going to make that assumption. It's going to fall fairly hard. It's going to fall fairly hard because of the higher PE, and people are going to assume they can't grow as fast. Also, their tech, people assume there's less investment in tech in a recession. So this one I would expect to get hit pretty hard if there was an actual full-on recession, but most stocks will. But this one probably specifically harder, but that's probably assumed. Another one, with cybersecurity companies specifically, we saw this CrowdStrike when there was a breach, there was a mess up, there's a mistake. These ones, you could see, okay, especially if you're like, hey, I want to sell this in 3 to 6 months. I really would prefer to have this money or move it out, maybe a group. You probably should make that decision quicker, because if you need that money and there's a major breach or something like that, I would assume the share price would probably fall fairly dramatically. Like you could see something like a 20 to 30% drop in a day or two if something went really bad, like we saw with CrowdStrike. Pull up the CrowdStrike, look over the last year, you can see a huge drop. You could maybe expect that with Palo Alto, so that's a risk. But I think as a long term, unless that breach was so massive that it had legal implications or the companies didn't want to use it anymore, that would be the major risk associated with this outside of it. So maybe if you take like a doomsday risk, okay, when investing in this company, there's this percent chance. You have a higher doomsday with a smaller company because there's less people, just the chance of fraud, whatever it may be. I would up that with Palo Alto just because their business is slightly riskier as well. But I don't think it's that big of a deal, and I want exposure to the cybersecurity industry because it is growing rapidly. It really is. Now, whether AI takes away some of that stuff, but like I said, they're integrating AI, so I'm not super worried about that. But who knows? But at least for right now, cybersecurity is growing, and like I said, even the areas that they do cybersecurity in, I think are pretty important, like specifically cloud. So I'm not too worried about that. Advantages, like I said, not a whole lot of competition, wide economic moat. There's barrier to entry with once you're established with large companies, there's no point in them really leaving unless you just totally suck. Also, software like that is super complicated to make. I specialized in writing some code and things like that in college, so I would know that it's it's complicated. And even then, the bigger barrier to entry, like I said, though, is just mainly once you're established, people just kind of use you. There's not like, oh, $20 billion other cybersecurity platforms people use. So I think the industry itself is really, really important. I think that's a large advantage. I think the fact that they've grown so fast, obviously have good leadership, obviously been able to establish themselves, I think it's pretty impressive. Now, I'm not the biggest stock price projection guy out there. If you watch my videos before, you know that. I don't like saying, okay, this stock's going to be this price by whenever. I'm not good at that. I feel like there's too many factors going into that. I'm good at looking at a company saying, okay, this is a good company. They've grown well. They have a good moat. They're in a good industry. They're profitable. They're not rich. Okay, I'm good at doing that sort of crap. And I feel like Palo Alto Networks is set up well for that. So long term, I think it's going to continue to do well. I do. I think it's going to outperform the S&P 500 on a long-term time frame, let's say 5 to 7 years. Of course, if there's a recession, that throws things off. But as a business, right, they're almost 2.5xing revenue in the last 4 to 5 years. That is very good. And even before then, it looks like growth was even better. They 10x'd revenue over the last decade or so. I don't expect that to happen. That is very extreme. However, I expect that profit margin to get up. I expect it to get up, and I expect it to get up fairly significantly, because when you look at $8 billion in revenue, they're making what, 600 million in profit, 700 million in profit off the top of my head, somewhere in that range. I expect that to increase fairly substantially in the long term, whether it be getting more efficient, cutting out some expenses, less on R&D. Generally, you don't see software companies have profit margins that small. I mean, look at some similar companies. Look at Intuit. Look at there's a bajillion others, right? Their profit margins are generally higher than what Palo Alto's is. So I do expect that. And I also expect revenue to increase, maybe not quite at 2.5 times every 5 years, but close to 2x wouldn't be that surprising. I don't quite expect it to, but also you would hope they did that. If this company doesn't grow a bit faster than the S&P 500, you're going to lose money comparatively, because the S&P 500 is cheaper, just off a PE basis, right? If we're saying the forward PE is correct, it's roughly, not quite, but you're at 60, right? So if one's at 60, one's at 30, you're growing at the same rate. Eventually, people are going to realize, okay, this thing's going to grow closer to 30 PE. I can just buy the S&P 500. Why would I buy this? Unless there's some real hopium or whatever in the future. So you would hope that Palo Alto, so even if they grow like revenue 2x every 5 years, you're still outperforming the S&P 500 fairly dramatically, and certainly if you get that profit margin up a lot as well. Now, I hope you guys enjoyed this video. That's all I really got. If you enjoyed, I appreciate if you like or subscribe. If you're new on this channel, I do daily stock content, so I'd appreciate if you stuck around, left a like, subscribe, and then watch content in the future. But anyways, I appreciate all of you for watching, and I'll catch you next time.